All right. Hello, everyone. Welcome to our October market commentary. Thanks for joining in today. I'm joined on this call by Evan and Amanda, who hopefully you guys are getting familiar with here if you've been watching our commentaries over the last couple months. Again, just like all the other ones that we've done so far, this will also be posted on YouTube. So, if you have to leave halfway through the live webinar or something like that, always come back. We'll get it posted on the channel for you. We've really enjoyed doing these commentaries. We've brought them back to monthly, just with everything going on right now in the market and in the government. And the goal is really just to be a resource where you guys can come and hear our thoughts, whether you're a client of ours or someone who's just following along. We love being here and giving our thoughts, providing our thoughts. So today we have here's our agenda for you. We're going to talk a bit about the elephant in the room, the government shutdown, right? Can't have a discussion today without talking about that. So we'll talk about that, how that's impacting people who are working, people who are on maybe administrative leave with the deferred resignation, and everything in between. Then we'll go through our normal commentary. We'll talk about the stock market, what we're seeing, what's happening in the economy right now, the bond market, what's happening with interest rates, with mortgage rates, uh, and how the economy is impacting that as well. So thanks again for joining us, for sticking with us. If you guys that are on live, if you have questions, we will be answering some of those as we go on. We'll leave some time at the end to answer as well. So if you're on live here on Zoom, you can use the Q&A box to type in any questions that you have. I'll try to keep an eye on that. If I don't get to them during the conversation, or if we don't get to them during the conversation, we'll leave some time at the end. All right, so let's talk about this government shutdown. Okay. Of course, everybody knows that it's happening. We don't know how long it's going to last. As government employees, this has happened a number of times throughout the years. You're well versed in kind of what this means for people who are working, right? Some people get furloughed. They get sent home from work. Essentially, you don't get paid during this time, but then you get back pay, right? Of course, there's essential employees, people like TSA agents. They are asked to still come to work. They don't get paid during this time, which is pretty difficult. So the big thing is expecting delays just about anywhere where an essential government worker is meant to be, since people are being asked to be there without pay, right? Now, the big thing that we wanted to cover, because we've had so many clients go through the deferred resignation program that maybe either just retired yesterday, right? October 1st was your first official day of retirement, or some of the agencies offer deferred resignation through the end of the year, in which case you're still on administrative leave. So something that's important to know about the shutdown right now is when you're on administrative leave, you're effectively treated as a furloughed employee, a furloughed government employee. So your pay stops, right? But you do qualify for back pay once the government gets started again. There's been a lot of nerves about if there's a government shutdown and you're on the deferred resignation program, what does that mean? All the communication we've seen so far has said that you should get back pay just like anyone else. Now, the other issue that this is going to cause beyond just getting back pay eventually is processing times for people who have just retired and they're beginning to get their pension. Okay. Um, Leading up to this over the last couple months, the OPM has already been advising people that things are going to be delayed. This isn't going to help, right? So hopefully in the months leading up to this, maybe we've been preparing for that, for there to be a delay. This could extend that a bit, right? Especially in getting some of those annual leave payouts and getting the pensions started. Now, without going into full detail here, I'm sure you guys are keeping tabs on this, but there's a handful of things that are really holding up the government right now in terms of the shutdown, right? Most of this has to do with healthcare and division there between Democrats and Republicans and what should be covered, right? Um, so far, this is changing, day by day, hour by hour on what they're willing to agree to, what they're not. There appears to still be a rift, um, especially when it comes to some of the affordable care premiums, the cuts that were made, additional cuts that were made in the One Big Beautiful Bill. So just, to highlight here, most of this does have to do with healthcare. We'll be keeping an eye on this. But when we look at this in historical perspective, right, most government shutdowns last under 10 days, right? Somewhere between 5 to 10 days. The average is around 8. Now, as we look at more recent history, past the mid 90s, we've seen some longer shutdowns. More divisive issues takes longer to come to an agreement. The longest being back in 2018, we had a 34-day shutdown, right? Of course, we don't know how long this one's going to last, but to put things in a historical perspective, the average is, 5 to 10 days. Okay. Now, as we transition from talking about the government shutdown, which we know is impacting your daily lives, right? For most of you, unless you're already retired. And acknowledging that that's a terrible thing. We want to get this resolved as quickly as possible. Our job as your financial advisor, financial professional, is also to look at this from a zoomed out perspective and say, okay, financially, economically, with the stock market, does the government shut down or have they historically really impacted things from an economic and stock market perspective? And the answer is that there's really no correlation to government shutdowns and negative economic impact. So when you look at this, we look at the stock market returns, S&P 500 returns during 1 month after and 3 months after a government shutdown throughout history. Overwhelmingly, especially 1 month and 3 months after, the market's positive, right? During the shutdown, because they have been so short on average, there's not a lot of data there, right? A lot of these you see, that first during the shutdown is maybe minorly up or down, but looking at a month, 3 months after, we can say with some certainty that throughout history, these shutdowns haven't impacted the market or the economy in a major way. So as we move on from this, we just want to do so with acknowledging that we're not discounting the government shutdown or the impact that's having on people's lives, but looking from a strictly economic and stock market perspective, that's the position we're going to take going forward from here. So we'll have Amanda talk about what's going on in the stock market. We'll have Evan talk about what's going on in the bond market, and then we'll wrap it up from there. So Amanda, I'll hand it off to you. Fill us in here on what we're seeing in the market right now.
Yeah, no, and thanks, Austin, for, like you said, kind of going on of what's kind of going on with the government right now. But, going off of where equities are now. So kind of going off of September, historically, September is one of the weakest months for US equities. Historically, from just from a return standpoint, equities return about negative 0.7% in the month of September specifically. That weakness is often linked to things like portfolio rebalancing, tax loss harvesting, and just lighter trading volumes after summer. But as we can see on the screen here, just based on the Russell indexes, September last month was very different. We see, September ended on a positive note. So what's really driving the difference, this year? We're still seeing companies post really strong corporate earnings, despite the tariffs, despite the inflation that has been posted. We still see really high optimism, around the Federal Reserve cutting rates last month, as well as the anticipated rate cuts that, Evan will speak to later in the presentation. And just continued momentum in a lot of the growth areas like technology, AI. especially as well. So these factors, carried over from August and are really keeping the rally going as, we see the numbers now.
Yeah, and just to draw your attention to something that we've been talking about throughout the year is when you look at the 1 year chart here, you can see how disproportionate the growth in the market has been this year. When we look at growth versus value, okay, so first off, looking at that, the large growth side of the market has seen a 24% increase this year, while the large value side of the market has only seen, under a 10% return. So growth being technology companies, right? Meta, Google, Amazon, Netflix. Value being more like Procter and Gamble, Walmart, Home Depot. The growth is significantly, coming from those higher tech companies. And then again, from a large versus small side, so large being up on the top, small being down on the bottom, we're seeing the growth concentrated in the large segment of the market, which is why one of our ongoing conversations has been around the S&P 500 and how concentrated the growth has been over in the S&P 500, which is becoming primarily a large growth. So just wanted to point that out, Amanda, to zoom out here over the year as well.
And perfect. And I hear from some of the comments that we might be a little bit echoed or things like that. I know I changed some of my audio, so please let us know if this is a little bit better or worse as we go on here. So apologize on that, but please give us some feedback. But as we take a look at this slide as well, just kind of taking it from now and also, back longer term. This chart shows, annual S&P 500 returns alongside, some of the pullbacks that we've seen historically since 1980. What really stands out is that even in, years with big intra-year drops, as we see, sometimes even more than, a lot of times 20%, markets often ended up, positive by year end, specifically 34 out of, the 45 shown. But really the key takeaway here is perspective. By highlighting this year alone, we've really already seen a gain of 14% year to date, despite the low point of negative 19% back in April. So investors who pulled out at that low would have missed, that quick, sharp rebound that we did see. So just kind of, really key takeaway here is perspective and keeping, in the market for the long-term growth there. I just want to make sure. Perfect. Hopefully my mic's a little bit better. But perfect. So next, just taking a look at how markets historically have responded, to the federal rate cuts. Now that we are officially a year out from the first rate cut in this cycle last September of 24, history will give us, a little bit of clues about what may come next. So on average, stocks gain about 9% in the first year after, cuts start, and, about 16 years in year two. And that's assuming that the economy going forward avoids a recession. And just taking a look at, our cycle in particular from 24 to 25, we're already outperforming that, 9% with this first year return just north of 17% here. So, and just taking a look at, based on year two, it tends to be strong because the economy often stabilizes, corporate earnings improve and investor confidence builds, which obviously we've seen over the last year here. But, taking that into consideration, and this is critical, but, if a recession kind of takes hold here, that pattern will obviously break. So really the outlook will hinge on, the economic backdrop. And right now we see some reasons for some optimism, but, risk remain. We still have some high valuations on the market that we've, talked about previously with some of the PE valuations. We have the budget deficit, some of that jobs data that we'll get into a little bit later as well. and some geopolitical uncertainty as well. So, just taking a look at year two, just some cautious optimism there. And lastly, just hitting on some international, developed markets have shown just some modest gain here, just supported by a little bit of easing of some inflation, central banks holding steady. Emerging markets are a little bit more challenged, just facing some, currency swings and just some slower growth in some regions, but we're still just longer term really still on the case for international investing and just remains strong from our perspective. The valuations, or that, like I mentioned, the PE ratios that we always talk about, they're still pretty heavily discounted, compared to the US, and just remain pretty bullish when it comes to, our portfolios and shifting more, compared to where we were at the beginning of the year. So, as we approach end of the year, the focus is still remaining on staying heavily diversified in international exposure.
Yeah, and just to chime in there, for those of you who have been our clients for a while, over the past decade, we've been pretty almost against international investing. We've preached against the I fund and the TSP. We've been heavily domestic in our portfolio, and we still think having a domestic weighting makes sense. We're not saying, hey, shove everything over into the I fund. That has its own complications, and we can talk about that more. But like Amanda said, at the beginning of this year, we were starting to see that, hey, these international companies are trading at a much lower price for the amount of money that they're making compared to U.S. companies, and we started adding more to the portfolio. So one of our biggest adjustments in the portfolio this year has been increasing the international exposure. Again, if you're a client, happy to talk more about that. We're still, under what most of the life cycle funds have in the TSP and things like that. We're probably still underweight when it comes to benchmark, but looking at this, it's encouraging to see that we're finally starting to get some global growth. We're getting some diversification in the market. So, yeah, just wanted to pitch in a little bit there on how it's impacting things that we're doing in our own portfolio. So, Evan, we'll shift to you now. We'll talk about some interest rates in the bond market.
Sounds good. The bond market, everyone's favorite topic. So bonds have actually had a pretty good year, which is anticipated when rates are coming down. There's an inverse relationship between the value of bonds and the interest rate environment. When interest rates are coming down, bond market value actually goes up. So this is anticipated for the year with the cuts that we've seen from the Fed. If we look at the chart in the bottom left, just to explain this chart a little bit, the left side is the credit quality, high credit quality, low credit quality, and the short and long is short-term duration versus long-term duration bonds. So if we look at the overall bond market for the year, up about 6%. Again, this was somewhat anticipated with the Fed cutting rates. Going forward, do we see bonds as an opportunity or a risk? Not necessarily either, more just bonds doing their job, being the ballast in the portfolio, getting more than you'd get in a money market or high yield savings account long term, but less volatile than the overall stock market, bonds doing their job going forward. Now, if we look at the Fed officials' expectations for interest rates, we know we got the cut last month. What do they anticipate going forward? These are the different dots on the chart. These are the different members of the Fed showing their anticipated interest rates going forward. So we can see that they're going to come down a little bit starting next year. And then towards the end of next year, the members are a little bit more spread across the board, but a median of about 3%. So if we continue to see the Fed cutting rates, we can see a similar story for the bonds going forward. Something interesting to note here is we just looked at the members' projections going forward. And what this chart is showing is what the market anticipates. And the market is actually anticipating that rates are going to go even lower than what the Fed is projecting. So if this doesn't happen to be the case and the rates don't cut at the anticipated rate and rates stay higher longer, we could see an impact, a negative impact in the stock market. Another thing to note here is you see on the news that the interest rates are coming down. So you might think that the mortgage rate that you would get currently would be lower. And that's not necessarily the case. That is the case with more shorter term loans like credit cards, auto loans, personal loans. Those get impacted quicker. But things along the lines of mortgages and municipal debt, those take a little bit longer to take place. Where if we look at September 2024, those rates were actually they're higher now than they were a year ago. So how does this look historically speaking? The trend is the same. So the dark red line is the average mortgage rate for a 30-year fixed, and the light orange is the Fed funds effective rate. You can see that the trend is the same. When Fed cuts rates, mortgage rates decrease as well. It's just not immediate. It's a little bit of a lag for the mortgage rates to get impacted there. So going forward, we can anticipate mortgage rates getting lower, but not necessarily in step with the way that the Fed cuts rates. We might need to wait a couple of months or a year to see the mortgage rates really coming down in an impactful way.
Yeah, I know there's a lot of people out there itching to refinance, right? And, if you bought a house in the last couple of years, you're paying substantially more than if you would have bought it in 2020. And we do think that'll be a possibility, but a lot of it, the Fed has been really hesitant, right, to lower rates too quickly because the economy has been so resilient. And the whole thing is they don't want to cause reinflation to happen. If you lower rates too fast, right, then there's a lot of money available. Reinflation could happen. But the line they're walking right now is if you wait too long and you keep money too expensive for too long, you could tilt the economy into a recession. And if that were to happen, we could see a more dramatic, something like what happened. You see what happens here when we get into a recession is they took the elevator down the other direction, right? And what the Fed doesn't want to do that. They don't want to take that measure. They'd rather, stair step this down and keep it around 2.5%, 3%. But that's all going to depend on whether or not, the economy actually finds itself in a recession.
Yeah. And one of those factors is job growth, where this was interesting that came out recently was we were anticipating really good job growth for 2025. And the actual revision has not been the case, where job growth has been not great for 2025. And this is one of the factors that the Fed is looking at when they're cutting rates. So if there's not a lot of job growth, it makes it hard to continue to cut rates. So that's something that we're keeping an eye on, whether the job growth still can lead to more cuts going forward.
Yeah, we talk a lot about this, and the difficult part of being in the investment world in this type of economy is we're really seeing a split happen between the stock market and the economy from an everyday person's perspective. We're seeing a lot of, like we said, there's positive things happening for the market. Rates are dropping, profits are high, efficiencies are there. There's still money being made in corporate America. But when you take a look at the everyday person, right, prices are getting higher, jobs are getting more scarce, debt is still expensive, right? And so we're walking this line between hey, the market looks good, but the everyday person is hurting a bit. So is that hurt going to start to impact the bottom line for some of these companies and impact profits and things like that? I know that sounds like a cold way to look at it, but that's the approach that we have to take is, okay, we see these things happening. Now, how is this going to impact kind of the bottom line? And you know, how are we going to get through that? And ultimately, how we get through that is, you know, we have to stay diverse. We can't put too many eggs in one basket. We have to prepare for cash flow, right? So these are the conversations we're having with people every day is, hey, we don't know. The market could continue to accelerate like it has. You know, some of these things could could catch up with the market. We could see a downturn. So we just don't want to get too confident in any one decision, right? We got to stay diversified, make sure you have enough cash to pay for your expenses, things like that. So, you know, a couple final thoughts, just to wrap up. Hey, we're in October now. We're officially in Q4. What are we talking to clients about, right? What are things that we need to be thinking about at the end of the year? Whether you're working with us, you're doing it on your own. You know, one of the big things that's a calendar year planning opportunity is Roth conversions. Okay, so if Roth conversions are part of your strategy, you're using these to lower your future income. That's a calendar year. You know, you have to get it done within 2025 for that to count for this year to take advantage of the tax rate you have this year. Additionally, you know, if you're over, if you have required distributions started, so now required distributions start at 73, potentially 75, depending on when you were born, if you're not already taking them. But those are also calendar year deals, right? You got to get it done during the year, and if you don't, there's some pretty serious penalties. Now, if you're taking required distributions, there are some planning opportunities there, right? You can do qualified charitable distributions. You can be giving money to charity instead of just taking it to yourself. That way you don't get taxed on it. There are you know, you can use maybe a required distribution to pay some of the taxes on a Roth conversion that you're doing, right? There's different planning opportunities, especially when you get into this into your 70s and you start required distributions. That doesn't just mean you're done planning, okay? So these are things that we're working on with people as well towards the end of the year. Now, we always wrap up with this. I never think it gets any less important, which is why we keep it in here. Especially in times like this, you know, the government shut down. It can feel, especially for those of you that are so closely tied to it, it can feel like the sky is falling. We try to maintain an outside perspective to help you see, you know, what's going on outside of that. So not letting your emotions drive your decisions, I think is really the biggest thing to consider when you're investing. Understanding your risk tolerance, know what risk you're taking, know if you're going to be comfortable if we do see some sort of correction in the market. You know when you're going to need your money and how you're going to get that and access that. Of course, being diversified, staying invested. For those of you that are clients of ours, we're hopefully helping you with all these things and answering these questions for you. So from there, you know, thank you for everybody who's attended this live. We're going to take a second here and we'll answer some questions for those of you who are on here live. So now, before we get into that, I just want to talk through this real quick, right? For those of you who are on this call or you're watching the recording and you're not a client of ours, we offer a free consultation. We call this retirement readiness meeting. We can talk about really anything, right? We could talk about how your TSP is invested, if you should be taking, when you should take Social Security, right? If Roth conversions actually make sense for you, right? Any of these things we can talk about. Now, just to be clear on this we call it the retirement readiness meeting for a reason. We really think you get the most value out of this meeting if you're doing it, call it within 5 years of retirement, or you're already retired and you're looking for some of these extra strategies. If you're earlier in your career, you know, I would recommend checking out our YouTube channel, checking out our articles. There's a lot of information that's on there that you can just grab for free. This retirement readiness meeting is kind of a one-time free offering that we do for people, and we recommend using that when you can get the most bang for your buck, for your free buck, by doing that kind of close to retirement. So if you're interested in that, you can scan this QR code or go to retfed.com/register.